Welcome to TMS Insights. It's June and Ben, it's a busy time of year. So we're going to climb right into some of the earnings related news that's been happening over the course of the last month or so. Some companies reporting out of cycle. They're, often a March year-end company, for example, but also some of the US companies. And thematically here, we're seeing the market push to higher levels, all-time highs, and some really good individual stock performances. But just to give a bit of a snapshot for everybody, Ben, the word inflation's come up a little bit in some quarters. I think Warren Buffett at the AGM for Berkshire Hathaway was one who mentioned it famously, and that's certainly taken some currency. So let's dig inside that and give everybody a bit of an idea of what we're seeing coming up there.
Yeah, I think we've flagged, on past videos that this is something we feel would get more attention, and I think that's still actually yet to come. I would say bond markets, which I know clients probably aren't quite as in front of as we tend to be, have really calmed down over the last month. In fact, 10-year bond yields in both Australia and the US are now trending slightly lower. The bond markets aren't overly concerned about inflation. We read a lot of global fund managers' quarterlies. There's a lot of different opinions on where the world is headed at the moment. But I would say that the bulk of the smart money still sees a transitory period of inflation.
So a short-term bump based on component supply issues.
Supply chains crunched.
And demand recovering faster than expected.
And border closures. Some of the companies we've seen updating recently, Costa Group as an example this week, great conditions across the company, but they can't get labour in to pick their berries. So the supply of people is actually, I think, becoming a real issue, particularly in Australia. Yeah,
and this is an issue. I was listening to the Prime Minister of Singapore actually talking there about the fear of this, the trade issues that were going to be legacy from the COVID 2020 year. It's just going to be different industry by industry, and I think some are obviously thriving in that environment. Ben, while we've got all-time highs, there's still a lot of stocks we can find that are very investable at this level.
Definitely.
And there might be a few that are a bit overpriced, but overall there's a lot of really good value stocks still.
Yeah, I think if you look at the blue chip shares in Australia, I can't remember a time since pre-GFC, so the 05-07 sort of bull market that we saw, where earnings momentum is so strong across those big names. You've got the resources, the banks, Wesseys, Woolies, Macquarie, CSL, et cetera. The earnings are growing very well across. Outside of that, there are pockets of areas that look good, and it's mainly businesses that have been hit by COVID. As the world is reopening, particularly in the US, the UK, we should see an acceleration in those businesses. So, things like technology and healthcare, I think are two of the main areas here. And probably I think the market is starting to also focus on businesses which have had an undue help from COVID and what the normalisation of those earnings looks like over the next year or two.
That will be the factor, because that's what the markets are interested in always, isn't the one-offs. It's always about maintainable levels of whatever we're talking about. So
structural changes.
Structural issues, exactly.
Versus a cyclical help or hindrance.
Correct. Now, just the one, we mentioned the companies that have reported here lately, they're eclectic in terms of covering different sectors. I'm going to mention some names, and we're going to just let everybody know that across this we're seeing good signs across what they do. So Xero, Macquarie Group, Fisher & Paykel Health, Aristocrat, the banks, and we saw, Ben, in each of those cases, things to like.
Yeah, absolutely. The market in some cases, again, it's expectations versus the numbers. But, I think if you looked at, let's go through them quickly. Aristocrat, which I think is a bellwether of what's happening in America. The CEO on the call, who lives in Las Vegas and, sort of travels in these areas frequently, he sort of said that getting a hotel room in 8 of the largest resorts on the Strip is now harder than it is on a normal New Year's Eve. So the boom that is coming in the US is significant. Their digital gaming business is shooting the lights out, but the land-based pickup that they're going to have as the reopening trade and Americans get back to doing what they love doing, it's going to go nuts. And so that's one stock I think is going to come roaring out of COVID. Whereas for other businesses, it's going to be a more muted recovery, I think.
Yep.
Macquarie, great result, but again,
It didn't get a reaction in the market. I
No.
think it still looks really good, circa $150.
Yeah.
There's nothing to dislike in the result.
Just a cautious outlook statement again, which is
They
what they're
always do.
famous for.
Always
They try and keep expectations low going forward, and then they'll come through, and we'll probably see a great update in how they're going at some stage in a few months.
Xero numbers were good. They did get a bit of treatment on the downside after the result, but they've bounced back.
Yeah, look, I think this was probably the best of the five that I saw. They added 244,000 new customers in the last 6 months. It's a weird business in that it actually costs the company money every time they put a customer on. It costs about $480 that they lose. They break even in the second year on that customer, and then they make about $1,500 a year in year 5. So the thing the market didn't like there is they said, we're confident we're through the worst of COVID. We're going to revert back to spending 75% of our revenue reinvesting back into our business. The market had a bit of a hissy fit on the back of that, but they have flagged continuously that was going to happen. So I think it's come back.
And you see that in other kinds of companies where they pitch themselves for the long term, and the market loves that reporting cycle and the sugar hit of something better today. So Fisher & Paykel Health again, just briefly on that one. Numbers,
80% growth in profit. Of course, the ventilator demand and all the stuff that was going on in hospitals was great for the business. The market didn't like the result. Well, the numbers were great, but the company didn't give any guidance, and there was about 30 bullet points on the things that could move their earnings.
Risk factors, they always have to have.
And good things that could happen as well. They said we could get one order from India and suddenly we're set up for a great year. We don't know if that's going to come through.
Uncertainty has upside factors to it, doesn't it? So markets don't always think that way in the short term. But now let's go overseas for a bit and just say, we heard from big tech and the big American companies in their quarterly reporting cycle. Maybe some really good news, Ben, overall, and a lot of all-time high sort of share price performances there. Maybe starting with Berkshire, which is always interesting for us. And they've been a really good performer in the last few months.
Absolutely. Yeah. I think aside from their investment in Apple, a criticism for the last decade of Berkshire was that they missed the tech revolution. They own a lot of economically reliant businesses, sort of the older school blue chip sort of names. Of course, that is what's booming at the moment. What is happening in the Australian share market is happening in every market around the world. It just depends on where they're up to in terms of their reopening cycle. And this is a golden time for Berkshire. Companies like Kraft and Heinz and Amex and Gillette and those sort of things, they're going great guns now. And on top of that, we've got this rotation into value out of growth that we've seen everywhere in the world. But but it hasn't necessarily parlayed on the big techs as much, has it?
No,
it hasn't.
It's more been an Aussie thing rather than those. But they're mega global companies, aren't they?
And probably more mature.
And their valuations still don't look ridiculous against their EV, EBITDA multiples and PE multiples, etc. So, there's still opportunity that they've got, and we're thinking that even though they could pull back a little bit with valuation things, I think there's a great long-term story in a lot of those.
I think one thing I'd just say on that, the two that really shot the lights out were Facebook and Google.
Yeah.
And that's because they're more exposed to discretionary spending on advertising. Yeah. And again, with the US economy is going into a real ramp up, that the market can see that coming, and it's starting to flow through in the numbers now.
Yeah.
Whereas, your Apples, Microsofts and Amazons, bit more of a muted, great results, but they're not probably catching that economic change that's happening on the ground.
No, excellent. Just finally for everybody, June brings about a number of things, a lot of activity around super, making sure your contributions are maximised, that you've actually complied with pension drawdowns. You see some tax loss selling in the market. You see some new positioning at the start of July from big fund managers. So it's a period of real action. So do get in touch with your advisor at TMS, and you'll find often it's a month where you can do some pretty good buying as well, I think, June. Yeah. So it's a month that you roll the sleeves up and get busy. So
no sell in May and go away this year again.
No, that didn't happen.
It's been, it's every little dip is getting bought. It still feels like the fundies are wanting to get into the market.
Yeah. Well, excellent. We hope to close out the financial year in good shape, and we'll be back in July with another update for you.